Thanks so much for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds on their investment construct, more so in the current times. Our guest today is Ravi Dharamshi of ValueQuest. Ravi, great having you. Thanks for being a part of Alpha Moguls.
Thanks, Neeraj. Thanks for having me. I have to say you're doing a wonderful job. One of the few long format interviews left where you can actually, investing is very, very nuanced, and sometimes this nuance gets lost in the need to wrap up things quickly. So I think you're doing a wonderful job.
Thank you, and it's our pleasure to have you, Ravi. So, Ravi, just before we get started on what your thought process is about the current times and portfolio generation, a lot of new people watch this. A lot of people on different platforms watch this. Can you just give us some sense of what is your basic portfolio construction strategy? What kind of an investor are you, or what kind of investor team is ValueQuest?
So, see, finally, everybody likes to put on a hat of either a value investor or a growth investor. I don't like to put on that hat. What we try to do is identify companies that are going to change scale. And that identification is done with the combination of top-down as well as bottom-up approach. We are neither only bottom-up nor only top-down. Having said that, we don't take too many top-down macro calls where what the market is going to do, what market is not going to do. However, though that ends up being bulk of the conversation that I have with most of the media people is about where the market is heading. Though we pay very little attention to what the market is going to do and more attention to which is the company that is going to benefit from the trend that is unfolding. So in a nutshell, scale change is where we focus, and that is usually backed by some amount of tailwind from the top down.
Okay. And do you take tactical cash calls, or are you 100% equity and 100% equity invested at most times?
No, we do not take so much of a tactical cash call. Having said that, today we are sitting on 10% cash. But again, that is not a cash call. It is a divestment out of an opportunity which we believe has played itself out. We are probably leaving something on the table for somebody else to make some money and waiting for the next opportunity to deploy the money. So it is just pure coincidence that usually these things happen at a time when market tends to be a little overvalued in the short run and gets corrected. But it has nothing to do with our view of global recession or India undergoing any kind of a challenge because of that. It is purely getting out of one stock and waiting for an opportunity to get into another stock.
Okay, great. Thanks for that. So let me try and get the basic environment construct from you, Ravi. I know you mentioned you don't take top-down calls, but I remember a conversation that we had maybe a couple of or 3 years back, where you said that we love being bottom-up investors, but every now and then the macro comes and slaps us, and then we realize that, hey, let's also take cognizance of that. So let's try and take cognizance of that. What's your sense of how tough the macro is, and therefore how tough would it be, or could it be, to make money in equities in the current construct?
Right. So in the parlance of weather analogy, so we cannot predict daily weather, but what we can do is predict seasons. So are we in a winter or are we in a summer? So I believe we are entering some kind of a winter scenario. So from that point of view, you have to be a little bit more careful about where you are deploying your funds, or what kind of opportunity you are going in for. So our macro analysis is restricted to the fact to understanding, if I were to use a cricket parlance, what kind of weather condition is there, what kind of pitch condition is there, and should we be trying to preserve wicket, or should we be upping our striking rate? So I think this is probably a condition where we will try and keep our wicket rather than trying to up the ante and play T20 style of cricket. So this is the time where not too many very obvious opportunities are available. So we will wait for that opportunity, but at the same time, we are not taking any cash call. We are staying invested because a lot of the themes and opportunities that we have identified in the last 6-12 months have not yet panned out fully. So we are staying invested with those because from a 3-year perspective, it still looks fantastic opportunity, and we should be generating 15% plus kind of a CAGR in those opportunities. So as long as that remains true, we continue holding on to those stocks.
Just simplistically, Ravi, if we take PE as a metric, you would want to pay a particular P both for the earnings growth as well as the valuation that you would give to any such opportunity. Do you reckon that in this winter-like scenario that we may be entering, until things change, the valuation multiples would be reset to lower for the country, for the index, for specific themes? Do you reckon there is a chance of valuation multiples getting downgraded in the very near to the near term?
Yeah, sorry, Niraj, I forgot to address the previous question in terms of what are the weather conditions like. I ended up giving a pre-match commentary, but I have to tell whether the pitch will bounce more or whether it will swing more. So I think, see, India is actually in a very, very sweet spot as compared to the world. We did not stimulate the economy as much as some of the Western developed economies did. And because of that, they are facing tremendous inflationary pressure. India actually did well to, people like to play the game of who to give credit to. So I'm not going to do that. But for whatever reason, we did not overstimulate. And because of that, today our economy is in good state. Our debt to GDP ratio is not bad. And most of that is still domestic. Our forex reserves are still upwards of 9 months in terms of number of months of import. Our tax buoyancy is very high. Some of the high frequency indicators are still indicating that there is still a lot of buoyancy in the economy. The festive season is just ahead of us, and there is a lot of chatter that this is going to be one of the best festive season in a long, long time. So everything said and done, India is in a very different situation from where the world is, where inflation is going through the roof, where the profit margins for the corporate world were at a peak and they are coming down. Valuations on those peak margins were very, very high. So there is a kind of valuation correction happening, which is far deeper in nature in the world than as compared to India. So I would say in a scenario where the interest rates are rising, coming back to your question about the P multiples and the valuation, India is still not in the same boat as the world is, where the 10-year has gone from almost sub 1.5% to almost 4%. For us, it has gone from maybe 5.86% to 7.5%. So it is a scenario where the money is becoming expensive, but at the same time, it is not such a scenario where India cannot handle the external shock. In fact, we have been using some of those shock absorbers and kind of protecting the economy as well as the consumer. For example, even in the fuel, we did not face the brunt that we saw when the crude went all the way to 130. At the same time, right now, I don't think if crude were to fall to 80 or 70, and we are very close to that, we will probably not get the benefit of that also. Most of it will be retained by the government. But that is actually not a bad strategy from overall economy point of view, because you actually use those reserves when the going gets tough. RBI has ended up spending almost $9,500 billion to defend the rupee at 80 level, and now since last week or so, it seems that they have let it go. They are not trying to defend a particular level. I think rupee is also a tool to control the imported inflation. So a little bit of inflation is going to creep through. So this week when RBI meet is there, we will see RBI raising rates. So that is another tool available for them to control the inflation. So I think currency is being let loose for just a little bit, and interest rate hike is coming. So that is why India is witnessing the kind of damage in the last 2-3 days as compared to what it was witnessing earlier, because in the trilemma of inflation, current account deficit, and currency, RBI is still trying to find that sweet spot. So that is where we are. So it is a challenging situation, but it is not dire. We should very soon reach a stage from where we should actually be looking to invest more in the market.
So just wondering, right? While you're a pure play equity investor, you would find merit or value in adding on to equities should other avenues not be presenting proportionately higher returns, so to say, for the risk adjusted manners, right? So do you reckon that a few 100 points on the Nifty, while valuations may still remain elevated compared to MSCI Asia or otherwise, India, because of the relative growth opportunities, will present the option of going all in, so to say?
So I don't think we are going to reach a kind of March 20 kind of valuation levels, or
Okay.
for that matter, 2013 currency crisis kind of valuation level. We will get slightly more attractive compared to what we were. See, I think what is happening is we are like that horse that has been held on before the gates open up, and we are allowed to bolt. Right now, it is more of a situation where we are raring to go, but there is no tailwind. There is a global recessionary headwind. So we are biding our time. What we have to ensure is whatever global accidents there are to happen does not impact us as a country and our portfolio in particular. So if we are in kind of again I'm switching between analogy, but we are in those middle overs where we need to ensure we take singles, doubles, and don't go all out, and just ensure you are at the wicket, and soon enough the pitch is going to be very, very attractive and to start playing a shot.
So what's the portfolio construct currently, Ravi? Is it more defensive bent, or how is it?
So again, I don't like to put any kind of label on the company that I buy, whether it is a cyclical or defensive or structural. Having said that, what we do prefer is a portfolio that is structural in nature, which is aided by cycles. So something that has a tailwind at its back is what we would prefer. And today, I would say that that kind of tailwinds exist in the domestic economy and not in the global economy. So we are heavily allocated towards domestic, in, if I were to say, sectors, financials, capital goods, which actually then manufacturing, real estate, and real estate includes some ancillary as well. And where we are clearly not invested so much is IT, pharma, and maybe some chemical stocks. Those are the places that we are trying to avoid, even though they are more structural in nature. But I believe they were kind of a beneficiary of bunching up of a lot of business during COVID times, and those unsustainable growth and margins got unsustainable valuations. From a next 2-3 year point of view, where I believe there is still some correction to be done before they become attractive. So maybe another 2-3 quarters, some margin pressure will be there in chemical companies and also in the IT companies. But at those point of time, those sectors will again become attractive from a 3 years point of view, and maybe we should try to allocate at that point of time.
Okay, so that explains the basic thesis, and I think this whole theory of import substitution as well has been there for a while. Let me still take the clock back to the previous answer that you gave, Ravi, and that is the other aspect, which is real estate, and a lot of conversation around how the cycle, which started 2 years ago, is actually a multi-year cycle, and there's consolidation of players, etc., which probably holds true. But does the rising interest rate or elevated rates, even if it doesn't rise too much, but if it's elevated, does it kind of put a spanner in the wheels, or would you believe both real estate and real estate ancillaries would continue to benefit?
No, so clearly some amount of impact will be felt, but today I feel we are at a stage where the bulk of the investment demand is out of the real estate market. It is more or less consumption demand. In the previous cycle, the component of investment demand was probably 80% and consumption demand was 20%. Today, it is probably the reverse. Consumption demand is 80-90% and maybe 10-20% is investment demand. So investment demand is the one which is more sensitive to this real estate, to the interest rate going up. The consumption demand, yes, there will be an impact, but as long as, see, what has happened is for 7-8 years, the wages kept going up, the supply kept coming down. So the affordability had reached a very, very attractive level. So that some amount of affordability now it is not so that the prices have gone through the roof. Okay, most of the real estate companies are doing well because the volumes have picked up. It is less because of the prices have picked up. Prices have picked up probably in a specific project where bulk of the sale has happened. Where only last 5-10% of the inventory is left. There, that is where some amount of pricing power to the developer is coming back. But if a new project is launched and if there is enough supply in the area, prices are not going up. But if a good product is being offered to the market, there is a demand for it. People are coming and buying. So whether it was work from home, which made people realize that they need bigger houses or they need to stay in a place from where they can work also, or whether it was the incentives that drove in the short run, which was provided by the state governments in terms of stamp duty, concessions and all, the demand has stayed up now good 4-6 quarters after those concessions have also gone away, and while those COVID concerns have also gone away. So demand has sustained, and actually the festive season is up ahead of us, and I believe even for real estate, this festive season will be a good one. So I don't think for us, the repo rate has probably gone from 4% to 5.5%. Maybe it will go till 6% also. But the home loan rate has probably, it had probably gone down to 6.5%. Today is probably at 7.5%. So, you're not going to postpone your decision to buy a house because you're paying 1% more EMI. So it is still within the range of, see, we have seen interest rates so high in our life in the earlier stages that this does not feel high at all. We have always been used to it. I'll just give you a perspective. I was in US 3 months back. Over there, the home loan rates have gone from 2% to 6%.
That's a real pinch.
That is something that pinches. For us, it has gone from 6.5% to 7.5%. Even if it is 8%, we have lived in that kind of an interest rate scenario. 8% still feels very, very attractive for anybody who's buying home. So I don't think interest rates are going to have so much of an impact. Though real estate stocks are interest rate sensitive that way.
Yeah.
Some amount of valuation impact can happen in the real estate stocks because of this.
Got it. What about ancillaries though? Because they have enjoyed a really good momentum the last couple of years, Ravi. Some of the good ones are again priced very punchy. You may have existing investments, which is fine. For people, if you are to deploy fresh money, would you find opportunities in the real estate ancillary space?
Absolutely. I think real estate ancillary is a far better way to play the real estate theme than the real estate developers. Purely because the industry structures are better over there. There is a multiple tailwind in terms of unorganized becoming organized. So the larger and the stronger guys are gaining more market share. So that is leading to consolidation. That is leading to some amount of pricing power being better than your returns are going to depend on the absolute size of the industry, how much it is growing, what is the structure of the industry, and which player you have bought into. So from that point of view, see, no one real estate player can ever be a leader. Even the leader will never have more than 5-7% of the entire real estate market. While it is possible that in a building material space, one particular player can have 30, 40, 50% kind of a market share. So, and that kind of a market share gives you dominance in the market, which a real estate developer will never have. So from that point of view, the industry structure is far better in building materials than the real estate developer.
And valuation is okay for you to put in fresh money?
Yeah, so in fact, valuations have corrected recently because a lot of that was driven by the raw material price increase. And now raw material prices have kind of a dual effect. It leads to increase in their sales because they sell on a fixed EBITDA margin. And when I say fixed, it is not the percentage margin. I'm talking about, let's say, for example, PVC, if I were to take, PVC is today available at, let's say, 100 rupees a kilo. I'm just giving a rough example. If the price goes from 100 rupees a kilo to 120 rupees, it leads to an inflation in the sales. At the same time, the margins compress because you're still making 10 rupees. Just an example, 10 rupees per what you are making on 100, now making 10 rupees on 120. 120. So your absolute EBITDA still remains the same, but as a percentage, it has gone down. Now in a falling scenario, when the 120 comes back to 100, instead of 10, you are going to make 10 rupees on 100 now. So your margins optically look like they're expanding, but what is happening is actually it's your sales that is compressing. So now we are in a scenario where some of these raw material prices are actually coming back down, and they will stabilize somewhere around here, and the volumes will pick up. So now the ensuing growth will be more volume led rather than price led, which was the case earlier, which is a far more sustainable thing.
Got it. Got it. Got it. Thanks for that. Ravi, a couple of follow-ups on this before we move on to the avoidance part in your portfolio. And then I would love to understand which of those books in your bookshelf is the one that is your favorite, which is the end of the conversation. First, defense. You spoke about looking at domestic economy facing themes. This one seems to have turned the corner after a lot of false starts over the last 10 years. It's out there. I don't know whether you have presence there or no, but what's your thought around defense companies?
No, I think we do have a presence in defense, and we are looking to increase that allocation as well. I'll tell you what, see, our most of the money that we have made in this market over the last 20, 30 years has all been on identifying themes. When an idea's time has come, nobody can stop it. Defense manufacturing in India is one such theme, and we are again seeing confluence of factors. Just like I explained in the geopolitical terms for the broad manufacturing, similar thing is happening in defense also. So, and we could have foreseen those things happening in chemical sectors also 5, 7, 8 years back. Today, of course, they are way overvalued as compared, and a lot of the growth was because of margin expansion and prices going up. So coming back to defense, I think the last move that government did, which is ban the import of some 400 odd items, is like the final confirmation that you need in terms of, you know what, now today, if army needs an X equipment or Navy needs something, they have no choice. They cannot import it. They have to procure it locally. So most of these, even the MNCs, those who have gotten a lot of defense orders, are now actually facing a penalty in case they don't have the offset clause. The offset clause ensures that 35, 40, or maybe in some cases 50% of the manufacturing is done locally with a partner over here. Now, or if they don't do that, they have to face penalties. Now that penalties are eating into their margins, and which is why this offset clause is actually benefiting the local players. So what was a pipe dream, say 6, 7 years back, today is a reality. And we can see it in the order books that some of these defense companies are getting. And what you can see is that right now there is a rush to book their capacities. Not only are they getting orders, they are getting good advances also. Otherwise, see, they are a small cog in the whole wheel, and there is not much value add that we are going to do in defense at this juncture. But the scale of a lot of these companies are going to change. You can foresee, I mean, you can judge the importance of this offset partner in the whole chain from the kind of advances and the concessions that their their clients are giving them. They need them more than local vendors need the client. So it's a win-win actually, but there is a demand, and there is a strong demand, and it is visible for next 3, 4, 5 years. A lot of these companies are going to change scale in terms of 3, 4, 5x. So this is the opportunity to look out for from the next 3 to 5 years point of view for sure.
One of the earlier participants, Ravi, mentioned that you can also look. His opinion was that the top tier defense firms probably have 15% CAGR growth or 10% CAGR growth for next 10 years. And then if you move down a ladder or a step, some of the slightly mid-sized ones may not have that much of longevity, but the next 3, 4 years visibility could be to the tune of 25 to 50%. My question is, one, is your thesis similar? And if so, which part of the puzzle are you betting on? Are you betting on the slow, steady, longevity, large players, or are you betting on the slightly second-run players?
No, so there are, we have a mix of both of them.
Okay.
And I would say that over a 10-year period, 15% CAGR might look, not very attractive. But what will happen is that it might be so that we might have a 20 or 25% CAGR for the initial 5, 7 year period, and then a slowdown, which might lead to a 15% CAGR. So a 25% CAGR in a large company is actually a fantastic number. So I would not, kind of discount the opportunity size or the growth that these companies are going to witness. Now, the good part about some of these smaller companies is, what was the bad part about this business, about defense business, was that one, your client is government, and second, your client is government. So, because your client is government, there is no visibility. So the biggest problem was the visibility. There was a lumpiness to this business, that you will not know when you will get the next order, if you will get the next order, what will be the size, when will you get the payment. The second big problem is, when will you get the payment. Some of the working capital used to be stretched to 1.5 years. Now, those two problems to a large extent at the current juncture have been taken care of. As I mentioned to you, that they are getting advances. That tells you that the pressure on the working capital is coming down. Now, if you are an offset partner to one of the larger guys, actually you are not, your client is not even a government, so to say. So you have far better visibility in terms of what business you are going to get over the next 3, 4, 5 years, and your payment terms are not as bad as they are with government. Although, albeit even that is getting better, but so some of the structural issues in this business are getting addressed, and we are in a phase where some of these companies are going to go up in a big time, and we have seen this. Even though some of the wealth created in the previous cycle in capex was transitionary, where these small players went from being 1,000, 2,000 crore turnover to 20, 30,000 crore. Now, if that is the kind of scale change that we are going to witness, some of these companies today, whatever their market cap are, they'll end up probably having an exit part of that kind of their top line will become their PAT in 5, 6 years time. So the re-rating is absolutely bound to happen in those kind of scenarios, and one cannot be stuck up in the past, that it has not happened in the past, this has happened in the past. So usually in times of such rapid change, analysts tend to get stuck with the old way of looking at things.
Yeah, I guess so. Okay, let me now shift focus to the pieces that you were talking of avoiding in your portfolio for the near term at least, right? And IT. We'll take 5 more minutes of your time if that's okay. Great.
Sure.
Okay, so information technology, right? For the last 15, 20 years that I've observed, there have been multiple times wherein obituaries have written for Indian IT for reasons which were much more grave than what the current one seems to be. My question, therefore, is the market wrong in writing them off currently, or do you believe that it could be a good tactical call, even if the market is wrong in writing them off completely? For the near term, tactically, it might be a good call to be underweight IT because you might get it at better valuations, nevertheless, even if you like it.
So I have seen these IT companies over the last 20, 25 years, and they have changed their scale. They have gone through tremendous metamorphosis. So I don't know if you recollect, but in the heydays of .com era, these companies used to grow 100%. So obviously at that point of time, their valuations were different. And today we are at a far more mature phase of the industry. So expecting these companies to grow more than 15, 17% for a extended period is also not a right thing. I think some of the larger ones are going to grow 12 to 15% over a longer term period. In between, we can have 2, 3 years. So like we had in the last 2 years, where actually we had slightly higher growth than that. And most of the growth actually was driven by margin expansion, profit expansion, and PE re-rating. So that is what led to the fantastic return. Most of the stocks gave anywhere between 5 and 10x kind of returns over the last 2 years. But now those margins are under pressure. And now suddenly you realize that they are in a more mature stage in terms of industry. Some of the smaller players can probably still grow 20% plus, but the larger players cannot grow more than 15% over a sustained period, is what I feel. So their valuations have to now adjust to that fact. And so at the bottom of March 2020 COVID time, the market was factoring in 5-7% growth. Today, market is factoring in, at the peak was factoring in 20% kind of growth, which is now scaled down to, say, 15-17%. So I would say now fair value is reached in IT, and some more downside, and it will become attractive again because market will start saying that no, they cannot grow at 15% also. That would also be an unfair assessment. So I would say it is more, IT is a mature industry, IT services, okay?
Sure.
But at the same time, there are some new areas coming up, whether it is IT products or SaaS companies, all those are still in the private domain and they are not yet in the public domain. So we'll wait for those companies to come, but that is where the real fast growth is happening.
Sorry, just a follow-up. Are you constructive on some of the listed ones which are not IT services, but IT product or platform companies? Are you selectively?
The space is attractive. We don't have any bet currently, and but I feel incumbents are at a slight bit of challenge as compared to some of the newcomers, because their way of doing business is completely different. So I think new business models are emerging, and they are going to challenge some of the incumbents, which might have the advantage of scale. But in a B2B business, it is very challenging to maintain your market share. You will see new players taking up, because finally the nimble is going to win and not the larger guy is going to win in the IT space, is what I strongly believe.
Interesting. Ravi, before we wrap up, what has been one of the favorite investment thesis of yours, if you will, and couple that up with one of the favorite books out of the 150 that I see behind you?
Yeah. So coming to defining the investment thesis, so I would say our investment thesis can be defined in single word as scale investing. What we are looking for is a confluence of top-down factors which is leading to tailwind in the industry, and at the same time a player that is best positioned to take advantage of that trend which is going to last 5, 7, 10 years. A combination of good balance sheet, great management with alignment of interest and execution capabilities. That is what you want to achieve. Most of these companies, when they change scale, they undergo a big re-rating also. And I would say scale investing is what defines our investment hypothesis. Coming back to the books, actually, I don't have a particular investment book for you today. We have discussed many investment books in the past, but the one that I'm reading currently, which is actually probably a path-breaking book in that sense, is one of the self-help, self-improvement books called Atomic Habits by James Clear. It's a fantastic book because it actually gives you small tips on how to keep on improving that 1% every day, on how to bring in that discipline in your thought process, in your habits. See, essentially what he's saying is that, first of all, you have to visualize yourself how you want to be 5 years, 10 years down the line. And then you have to take those small steps to becoming that person. Even if you're moving slowly, that's fine, but move in the right direction. Don't move backwards, at least. So persistent, incremental steps is what is required to reach your destination, reach your goal. Everybody starts off with the same way, but the difference between somebody who achieves the goal and somebody who does not achieve the goal is that consistency. And that consistency is, it is not, motivation is actually an overused term. It is very difficult to maintain motivation over a long period of time. So the only way out is for you to develop a habit, and habit beats motivation any day. And the way to go about building habits is to make these small changes rather than trying to take a big leap.
Yeah, it's a fabulous book, and thank you for recommending it again. It's about time that anybody who hasn't picked it up should pick it up. And for me, who's picked it up some time back, to reread again is just that wonderful a piece to read. So thank you for reminding that. And more importantly, Ravi, for a bunch of things that you've spoken about on the show today, thank you so much for speaking those and for being a part of Alpha Moguls yet again.
Thank you so much. Love being on the show. Thank you, Neeraj.
Yeah, pleasure is ours, and viewers, thanks for tuning in.